and welcome to the Fundamental Value podcast, hosted by Joshua Frank, co-founder and CEO of the TI. On Fundamental Value, we speak with leading analysts, traditional finance and digital asset firms, and investigate how leading minds in the cryptocurrency space research, analyze, and quantify the value of digital assets. Quick disclaimer, this podcast was recorded and is being made available solely for informational purposes.
Today I'm excited to be joined by Theo Rozencwajg, co-founder and CEO at D2X. Theo, it's great to have you on.
Hi, Josh. Thanks for having me.
So let's get right into it. Can you walk us through your background pre-crypto? We can even start at our McGill days, maybe. So yeah. Theo and I were fraternity brothers, if you can believe it, back at McGill a few years ago. So
Indeed. Goes back a few years now. I'm French originally, grew up in Luxembourg, then moved to Canada for my studies. As you mentioned, McGill is where we met. So I did a bachelor's in mathematics. That time also really got interested in financial markets in general. So I got my first professional experiences during that time as well. After McGill, I moved to London and basically started my career at Natixis, the French investment bank, where I was covering hedge funds and asset managers for the volatility trading business. So really on the equity derivatives side of things, trading lots of product, light exotics, but also a bit of flow and vanilla. One that really got my interest was dispersion trading, really a fascinating product. So I did that for a little while, eventually decided to leave the company and go back to school. So I did a graduate program in finance this time at the London Business School, and then received an offer from a company called All Options, which is a big derivatives market maker based here in Amsterdam, where I'm currently based as well. And basically, I joined them to help them set up new trading desks. So they were effectively at that time rebuilding and restructuring lots of their core trading activities. So I joined and was a derivatives trader, trading listed options first on the AEX, which is the Dutch index, then moved to single stocks, first with a focus on the European tech sector and European banks. This is also where I met Don, who is now the CTO and one of the three co-founders here at D2X, and that's where sort of the crypto journey began.
Yeah, and so why leave? You just graduated business school, got a job at a top, market maker, and very quickly left that job to start D2X. So why start the firm? What was the opportunity or the problem that you saw in the market, and why crypto?
Yeah, all really interesting questions. I was actually in a good spot at the time, really in a job I enjoyed. Also, All Options was and still is a great company, so I really enjoyed my time there. What happened essentially is Don came up to me one day and sort of piqued my interest for the space. So he has more of a crypto background. He's been involved in the space since 2013 already. Had a first company in the industry as well, and basically came up to me one day, said, "Hey Theo, something interesting going on in the derivative segment of the digital asset space. You should have a look." And basically, we started doing some research on the asset class. And derivatives in particular, and spotted a very interesting business case, but initially from a market making standpoint. So what we wanted to do at the start was try and set up a new trading desk to basically start trading futures and options on crypto, and quickly realized that it was actually very difficult for European institutions, and especially if you're regulated. So All Options being a regulated company, we would have faced lots of operational and regulatory hurdles to basically start trading the asset class, and realized at the time that this was really the common theme in Europe for financial institutions. Basically, you want to get exposure to this new asset class, but there are so many hurdles in the way, so many risks, counterparty risk, credit risk, operational risks, reputational risks also. for the larger players, and then realized that fundamentally there was an absence of regulated market infrastructure to allow institutions to trade these products. And that's really when the sort of entrepreneurial mindset kicked in, and it almost became an obsession. There was really this need for this market infrastructure, and we decided not to wait for someone else to build it.
And so, yeah, tell me about D2X. So what is D2X? When's it launching? Who are you servicing? And how's it different? And also a question that, as a fellow entrepreneur, right? Oftentimes when somebody originally sets out to build a business, what they end up building is a little bit or very different. So how has, to this point, you're about 2 years into this journey. So, in addition to what is D2X, is how or is it different than what you initially set out to build?
Yeah. So maybe I start with a small introduction on D2X and what we're building. So what we're building is really the first pan-European exchange that will be a regulated trading venue where financial institutions will be able to trade futures and options initially on Bitcoin and Ethereum. So currently, if you look at the market, there are certain trading venues that are not regulated, typically based offshore, the likes of Deribit, for example. And you have regulated entities in the US. So if the CME would be a good example. But what we're building is really the first market infrastructure that will comply with European regulation, and where basically these institutions will be able to trade these products. We're basically applying for a license, an MTF license here in the Netherlands, which is a license that we can then passport throughout the EU and the EEA. It's a license we applied for a few months ago now. We're basically interacting with the Dutch regulator in order to obtain that license and go live, we believe, around March 2023. So that's when we expect to go live. The types of clients we service are exclusively financial institutions. So we don't accept retail on the exchange. We only deal with regulated entities, typically based in the EU and EEA, though there are certain exemptions that allow us to accept members from other states as well. So these would be your typical financial institutions, investment banks, hedge funds, asset managers, brokers, market makers. And what we're really building here is a sort of plug and play solution where institutions will be able to trade these products just like I would trade derivatives on any other asset class. And one of the ways we do that is by listing derivatives that are cash settled and denominated in euros. So this has pretty important implications. One, from an operational standpoint, there are no custodial hurdles with trading on D2X because everything is euro denominated. The other point is, from a regulatory standpoint, we actually don't fall under crypto regulation because there are no digital assets flowing through the exchange at any point. And again, everything is euro denominated. So because we list derivatives, we fall under MiFID, EMIR, so sort of your traditional financial markets regulation here in Europe. And so that's really the approach that we had. What we decided to do was to go with a regulatory first approach. So the design of D2X is actually reverse engineered from the regulation. You were asking also about sort of the entrepreneurial journey here, if we pivoted since the start. And actually,
did you always plan on being cash settled? Was the goal originally just settle in crypto, or?
We quite early on we decided to go for the cash settled euro denominated route. The reason being that we see that as the more sort of institutional friendly product. What financial institutions care about is the exposure they get to the asset class. So typically they will also report at the end of the year and not in crypto. So if we can reduce the operational hurdles, the regulatory hurdles, by doing that, we think it's the right thing to do. From a regulatory standpoint, many institutions are also simply not allowed to trade these products, whereas cash settled derivatives really fit.
And can they not trade on the CME?
So some institutions can definitely trade on the CME. What you will typically find is that the very large institutions will already do that, but the CME presents its own set of flaws that we also try to improve. It's fundamentally quite expensive for European institution to trade on the CME. You also have to align to US regulation to some extent. It does involve quite a few intermediaries, and in our model, you could be directly trading on the exchange. I was talking about some of the CME's flaws. So, I mean, they did a pretty good job at sort of delivering their crypto offering. Where they are struggling a little bit, and where we think we can really improve the status quo, is in terms of margin requirements. So trading Bitcoin futures, for example, on the CME is not very capital efficient, and we have a model in which basically we're building a hybrid version of sort of the traditional clearing model and the approach that you would see on crypto native trading venues like FTX, like Deribit. And what that does is we have a much more capital efficient experience of trading with lower margin requirements in order to cover for the same amount of risk. That's possible thanks to two things. One is the fact that we'll have longer trading hours than the CME, so we basically don't have this weekend gap, for example, that they would have. And the other thing is cross margining that many crypto native trading venues do not facilitate. We're also partnering up with a tier 1 EU bank that will effectively hold all the collateral, which will be in euros as well, for us, because we can do that. We're not a bank. And effectively, by doing that, we also mitigate lots of other risks that you would have as an institution when trading on crypto native trading venues. The main problem when you trade on these crypto native trading venues is effectively you have counterparty risk towards the exchange, right? You're actually trading against the exchange. So if the exchange goes bust, well, you're left with nothing. Typically, they're not regulated, not audited. So it's quite risky. Typically, the trading is also pre-funded, meaning you deposit collateral to the exchange, which means that you also have credit risk towards the exchange. In our model, we're never counterparty to the trades, and the collateral is held with our banking partner. So what that means is, as an institution, you trade on D2X, you have zero exposure to the exchange.
And so, there are so many crypto exchanges, right? There are hundreds, if not thousands of these things, right? Most of those exchanges are spot. Why do you think there are so few derivatives exchanges and so many spot exchanges?
Yeah, so I think there are two reasons, two main reasons. I think the first one is really a function of the maturity of the asset class. In order to have a liquid derivatives market, you need a very liquid spot market. So we're talking about an asset class that's still quite young. It is becoming quite liquid and more liquid by the day. So now basically you see the business case for derivatives starting to make more sense. Had you launched a crypto derivatives exchange 10 years ago, it would have been very difficult to get any liquidity on the exchange, simply because spot wasn't as liquid. If we dig a little bit deeper into that, I think the natural evolution is typically you start with spot, then you have a futures market, and then only you would have an options market. So right now, if you look at the state of the asset class, options are still relatively illiquid. That's partly due to the lack of institutional grade market infrastructure, because these are institutional products typically. But yeah, with solutions like ours, we really expect to see the options market develop much further. The other reason why there are so many spot exchanges and not so many crypto derivatives exchange is the complexity of the market infrastructure that is required to basically have a liquid derivatives market. when you start introducing derivatives, you start introducing basically risk management because you have to post collateral. So that introduces risks like liquidation risk and all these things that you wouldn't necessarily have with spot. And also from a technical standpoint, and that's something we're experiencing at the moment, building the infrastructure for derivatives exchange is actually much more complicated than spot. And it's also extremely latency sensitive.
And so if we look at traditional markets, whether it be spot or derivatives, those are very consolidated markets, right? There are very few exchanges, there are very few players. Do you think we'll eventually see that same consolidation within the crypto derivatives, space? One of the things that we've kind of, seen, previously is, derivatives exchanges in crypto popping up, becoming regulated in specific jurisdictions, and then getting acquired, right? And there's I think ErisX and LedgerX are two examples of that, right? Where do you think D2X fits in that picture? Like, do you view yourself as an acquisition target for a larger exchange that wants to, FTX wants a regulated derivatives exchange in Europe, they come out and buy you? Or is your plan to go out and compete? And do you think there can be a large number of players in the space?
Yeah, so I'll start by answering the first question on consolidation. I think there's definitely a case to say that we will see some consolidation. At the end of the day, crypto is an asset class. So what we see in the more traditional asset classes is likely to sort of repeat itself here. Consolidation doesn't mean it's a winner takes all type of business. I think if you look at other asset classes, what you typically see is 2 to 3 players that each have a set of USPs, and they will have a specific focus, and then basically share the market. There's also typically a geographical split with these. So, like for every asset class, you basically have exchanges in the US, in Europe, in Asia, and the reason there is this split is mainly regulatory reasons. So we also expect consolidation, but it doesn't have to be a winner takes all. So we really think that there's a big gap here in Europe, and that's effectively what we want to capture. To your second question on the ambition for D2X, we're not building this to get acquired. The ambition is much bigger than that. What we want to become is really the leading market infrastructure for digital assets. So our angle initially is derivatives. So we're building regulated market infrastructure for derivatives, and we want to expand both in terms of the products that we list, the features that you will have on the exchange, and really all the services that we could provide. The name D2X Group also hints towards this ambition to do more. That's not to say that there will never be a merger or anything like that. I think we're pretty open to everything. I expect that there will be quite some interest, especially when we get the license. But the ambition is to bring D2X as far as possible, and then we'll see what happens.
And so, speaking about, a lot of what this conversation is around is regulation, right? You guys are taking a regulatory first approach, focused on regulation in Europe. But how is regulation in Europe different than that in the United States? What are kind of, is it more challenging to get licensed in Europe than it is in the US? And what actual licenses do you need? I mean, I know you mentioned a specific Dutch license that you were talking about. And so what are kind of the challenges of obtaining those licenses? There are really 2 parts, right? How is the US different or how is Europe different than the US? And what do you actually need in Europe to become fully regulated? And what's that process look like?
Yeah. So I think it's quite important to make a distinction between crypto regulation and financial markets regulation. So in Europe, for example, if you look at crypto regulation, there's this regulation that has been passed and will be implemented in the coming years called MiCA. This will basically regulate digital assets as an asset class and also service providers and so on. It's actually not a piece of regulation that we will fall under. The reason, again, being that we do cash settled derivatives that are denominated in euros. So actually our products, they fall under MiFID, which is really the sort of traditional financial markets regulation here in Europe, if you will. And it's really important to understand that getting a crypto license or getting a license under MiFID is actually quite different. There are many jurisdictions in which you can also get local licenses in Europe, and that actually will also answer part of the question on the differences between the EU and the US. The problem right now in the EU, when you look at crypto regulation, is it's extremely fragmented, right? So now MiCA will come into play, but until then, every jurisdiction has its own sort of local framework. And what that means is if you're, for example, a Dutch exchange and you want to deal with French clients, well, you would need a license here in the Netherlands, but also one in France. So it makes everything very fragmented. It's not very scalable, and you would need jurisdictions in every. You would need licenses in every jurisdiction you want to operate in. The reason we decided to go and to design the model to make it work under MiFID is so that we can have a license that we can passport throughout Europe, because MiFID applies to the EU as a whole, and that's really sort of this framework that we know, that we're comfortable navigating, and that institutions are also familiar with. So it makes it quite easy for them as well. I think if you look at traditional sort of TradFi regulation, I would argue it's quite similar in the US and the EU. Of course, there are differences, but sort of the idea behind is really the same. But crypto regulation, it's only just starting here in Europe, and I'm actually not an expert on US regulations, and not able to.
I wasn't asking for the most in-depth answer there. Don't worry about it, Theo. But a question. You've talked a lot about basically trying to fit into and you are for all intents and purposes given that you're cash settled, operating more like a TradFi exchange, kind of like the CME offering cash settled in the US, right? And so why can't any other European derivatives exchange that offers more traditional assets just offer the same exact service that you're trying to provide?
Yeah, great question. So there are a couple of reasons. First, I'd like to point out we often refer to ourselves as hybrid type of player. The D2X is really a hybrid between TradFi and the crypto ecosystem. So we try to take the best out of both worlds and really bridge the gap between the two. There's fundamentally a lot of value, lots of interesting aspects in both segments, and we basically try to straddle these two areas. If you look at the TradFi regulated exchanges, so in Europe it would be like Eurex, Euronext, there's a problem that they're facing around clearing in particular. So they typically operate under different kinds of licenses. So if you look at the derivatives offering of Eurex or Euronext, these regulated exchanges, they will do that under a license called regulated market, which is a different license than the one we're applying for. And this license actually requires you to have your derivatives cleared. So then the question would be, so why don't they just clear it? And the problem is the clearinghouse is actually typically independent. So sometimes it's integrated within a group. But unlike the US, where it's actually much more aligned, the regulatory process here to basically start clearing new products is actually quite lengthy. And if you look at the EU, there are no CCPs, so no clearing houses that are clearing these products. So they're basically not able to list these products. So what they will try to do is basically find different kinds of products. So they will have, for example, a Bitcoin ETN, and then they will list futures on that, but that is a different animal in that sense. So it's mainly for regulatory reasons. And And I would argue they're also a bit slow. These institutions, that's a problem that comes with size. The demand is clearly there, but it's basically a sort of new infrastructure that they have to build. And if you look at how it happened in the US with the large exchanges, is they will often look at acquiring smaller players. So rather than building it themselves, they're just waiting for someone to do it, and then they try to acquire.
And so, you guys are launching in March, right? And on the second you launch, right, you have no existing clients, right? Obviously, you have to go in and you're building this from scratch, right? The CME came out with the CME's list of clients, right? But granted, Binance started with no clients either, right? You got to start somewhere. So how do you go about attracting liquidity to a newly launched exchange, right? I'm assuming, attracting market makers is probably easier, but how do you attract the takers on that exchange?
Sure. So I'll start with the first piece. So really on the liquidity side of things. So we're already backed by several market makers, and we have very strong connection and ties with the market making ecosystem here in Europe. So you can think of all the larger traditional market makers that are trading every asset class, and that are now also trading crypto or crypto-related products. The way we attract them is done in sort of two ways. The first one is by an investment, so sort of these strategic types of investments, these partnerships. And the second one is by designing a model to incentivize them that is actually closer to how they trade in TradFi. So if you look at the crypto native world, you typically have taker and maker fees that are basically designed to try and incentivize liquidity. Our approach is actually that of TradFi, where we have market maker programs. So what that does is effectively you basically almost pay for liquidity in a way. So these are essentially quote requirements where we tell the market maker, if you quote this amount of size on this number of products for this amount of time, you will get rebates on your trading fees. And this is a model that market makers are used to, and that works really well. So this is really how we get the liquidity piece, and that has gone very, very well so far. So we already have a long list of market makers that will trade from day one. Now you were also talking about the takers, so really the order flow, which of course is really a chicken and egg game with liquidity. Our strategy here is to basically go after the prime brokers. So by doing that, we sort of open up to a very
You mean the traditional as opposed to the crypto prime brokers?
Correct. So some of them are also hybrid. Some of them are also straddling both spaces, and these would be good candidates to be prime brokers on D2X. But indeed, the large traditional ones that basically would be able to trade on D2X because they're regulated, we also target them, and then they will effectively redirect the order flow from their end clients to us. Another way we approach this is via these liquidity aggregators and RFQ type of platforms. Paradigm is an example, because we'll also have a block trading facility on the exchange. So just by being plugged on these services, we expect quite some order flow to land on D2X. And actually, it's quite interesting for both market makers and takers that we're not just capturing a part of an existing market, we're also creating a new market. And the reason I say that is right now there are many institutions in Europe that basically want to trade the asset class but haven't found a way to do it. So there's basically all this order flow that's just sitting and not really being and it's not really executed anywhere. And once we develop that regulated market infrastructure and bring it to these institutions, these will be basically new flows that we will start seeing in the asset class.
And so you mentioned Paradigm. Paradigm is primarily Deribit. I guess there is some CME trading mixed in there, but it's primarily, Deribit settled trades. Do those folks care about interacting with a regulated European exchange? Why should they care about D2X?
Yeah, so at the end of the day, it's really the end clients, right? Some end clients that could be using Paradigm might be required from regulatory standpoint to execute on a regulated trading venue. So it really depends on the end client.
And I think to your benefit, right? Like, a point you made earlier, the CME is only open Monday to Friday. So maybe they are trading on the CME on Deribit, but you're offering them a weekend option too.
Yeah, exactly. So there's that, and then of course there are other advantages to trading on D2X. Capital efficiency is something that we talked about, and we also talked about certain types of risk. The fact that crypto native trading venues present lots of risk, counterparty risk, credit risk towards the exchange. Well, we don't have that. So whether you have to trade on regulated trading venue or not, I would expect most institutions to want to trade on a venue that is both liquid and safe in that sense.
And so, we talked a lot about regulation, getting the exchange off the ground. Let's talk a little bit about the actual client landscape and makeup in Europe, right? How does that compare between the Europe and the US? I mean, one of the things that I constantly hear is that, European institutions are just slower moving. And we have some experience working with a few of the banks in Europe, and it's been a painful experience just in terms of the amount of compliance and, I'm just going to say nonsense that we've had to deal with to kind of get them, and just kind of filling this back and forth. But I'm curious, like, obviously there's a ton of activity in crypto in Europe, but how does that compare to the US? And, since you started about 2 years ago, has that accelerated? Do you think it's accelerating as fast as other jurisdictions?
So I would argue it's actually quite similar. I think the landscape is pretty similar, and especially in the derivative space. If you look at funds, for example, so on the buy side, there's not really a difference, but because oftentimes the funds are based offshore or in the UK, for example, but they will have different entities and trade both in the US and Europe. So I think for the buy side, it's actually quite similar. And then, so here in Amsterdam, for example, you have this very active market making ecosystem, which is actually quite similar to the one in Chicago, for example. So there's a lot of similarities. If you look at adoption, and that applies to everything, so every asset class, every type of product, the US typically leads. Asia is also usually pretty fast in adopting, and the EU typically lags by a year, 18 months maybe. This is actually quite good for us because we can simply look at what's going on in the US and prepare that for the EU. But I think it's quite interesting to see how institutions are now reacting to the current price action, for example, where in previous bear markets, you actually felt institutions really losing interest in the space and getting cold feet.
Well, I mean, I think the best example of that, right, is the fact that everyone's like, "Oh, crypto is correlated to traditional assets." I'm like, "Yeah, that means institutions are here."
Yeah,
it's not retail anymore.
No, indeed, exactly. So there's really this trend of institutionalization, and we see that across all geographies.
So I actually have a selfish question, because this is actually a question that I want to know the answer to personally. What is the TAM in Europe for you guys? How big is the market? How many crypto hedge funds do you think there are in Europe, or hedge funds that are interacting with crypto? How many potential clients? I mean, this is a question that I ask. Like, we just set up an office in Singapore. We're still trying to hire people in Singapore, by the way. We've been trying for months. So if anyone's listening, wants to work for us in Singapore, send me a message. But in Europe, this is a question we have as well, is like, should we set up an office in London? Like, how big is the addressable market? We go a lot of times for conferences, right? And I'm sure we'll see you at DAS London and a few of the other ones coming up soon. But, how many players are there? And how many crypto natives? But more importantly, like, how many of these traditional guys, or what percentage of them do you think are going to get into crypto once you enter the space?
So it's really a question of timeline. I think at the very start, so when we launch around March next year, we don't expect every institution to come on board, but we expect every institution to know what we're doing and start basically
And do you have any idea of how many every institution is? Are we talking about 1,000 organizations? Are we talking about 5,000? Do you have like a general sense? This is a selfish question, by the way, so just so the audience knows.
Yeah, sure. I mean, it's always, what defines an institution.
Yeah, in crypto, it's a very big word.
Exactly. I think a lot of small trading desks that made a lot of money during bull runs now call themselves institutions. So in our definition of an institution, it's basically a sort of professional client.
Basically, anyone who set up an LLC or better.
Yeah, pretty much. No, but I mean, it's like, there are, of course, hundreds of really large players that we can target here in Europe. So the large asset managers, there is many of them as well that will trade the asset class. It's difficult to put a number on it, and we don't.
Yeah, I mean, for perspective, this is a question that I struggle with all the time. Coinbase Institutional, I believe, has around 3,000 clients. Falcon X is about 1,500, right? And there's a few others. I think Fireblock says they have around 1,800 or 2,000 clients, right? So obviously they're going to be high net worth and retail mixed in. There's going to be foundations, but I presume a token foundation could hypothetically trade with you too. They're also doing treasury management, right? So it's this very difficult question, but we think there's like 6,000 or so traditional hedge funds that exist in the world that are like legitimate real hedge funds. But to your point, there are a lot of mom and pop operations that exist in crypto too that maybe don't fall under that that broad definition. Yeah.
So the way we look at it is more in terms of volumes. To us, it's much easier to try and engage that. So if you look at derivatives, you're consistently above around $3 trillion per month in volume right now in the space. That's worldwide, of course. And what we forecast,
it's notional volume, or
yes,
okay.
So what we forecast during our first year of operations is between 30 and 50 billion. And that would be for the first year, and that assumes a relatively small market share. So the way we approached that was to look at volumes in the US and try to convert that into what we believe would be a reasonable estimate for Europe, looking at the ratio for other asset classes, and we also assume this time lag that I was.
I mean, how much crypto is traded euro denominated? I have to imagine it's a pretty small. I mean, because most people in crypto are just trading with like not even US dollars, but with stable coins.
Yeah, it's actually quite difficult to estimate, to be honest, because a lot of it is also OTC, so it's difficult to get a good measure. If you look at euro pairs, for example, they're still relatively liquid.
Do you think the asset managers in Europe that are trading crypto with OTC desks, like take somebody we both are friends with? I just had the Cumberland folks on the podcast, or Wintermute or anyone else. Do you think they're trading euro denominated a lot of the time?
I don't think they are, but I don't think they would mind.
Okay.
So if you look especially at the TradFi players, it's not a problem, to trade in different currencies. A lot of European market makers that do most of their operations in euro.
It's basically 1-to-1 anyways at this point. So
sorry,
I said it's effectively 1-to-1 anyways at this point. I mean, a euro and a dollar are basically exactly.
It's pretty much the same thing. It's a fork of the same.
Exactly. Yeah. We'll see which one is algorithmic, and we'll go to zero first. So
Yeah. No, but effectively, it's a small FX exposure that some of them will take, but these are typically hedged top level, so they don't hedge that per trade.
It's very easy to hedge the US dollar euro pair. That's a very liquid market.
It's pretty liquid.
And so, you talked about launching. You said March, I believe. So
that's the target. Yes.
The target. Okay, got it. So, look, that's a long time from now in crypto. I actually had written down a question. Are you nervous about launching under current market conditions? But who knows what crypto is going to look like in March? And so, do you think do you think these current market conditions have any impact on your roadmap? Change anything? Change institutional adoption?
I mean, current price action definitely could have had an adverse impact on launch had we launched now. But as we were saying, it really does feel like this time institutional appetite is still there. There are some really serious initiatives that are taken by most large institutional players in the space, and I think everyone understands now that it is really its own asset class. It's here to stay. These market conditions are also really great time to build. I think a lot of people say that, but I actually really do agree. It's in a way a test of resilience. So I think it's quite healthy also to have these sort of market corrections that corrects this exuberance that you get sometimes in crypto. If you look at the derivative space in particular, it's actually extremely resilient to price action, which is great. If you look at derivatives volumes, they're actually quite stable even during current market conditions, and they're increasing pretty much month on month, both in absolute terms but also relative to spot. It's also interesting to note that if you look at spot versus derivatives in crypto, that they were around 50-50 for a number of months, and now you're now seeing basically derivatives volumes really starting to pick up and are now representing a larger share of the overall volume. And what we see in traditional asset classes is that derivatives volumes will typically converge to an order of magnitude above spot, and we expect to see that in crypto as well.
And so, we've talked a lot about D2X and launching the exchange and all the things around it, but how many products are you planning on launching? Like, how many assets do you want to support? Obviously the CME is just Bitcoin and ETH at this point. But there are a large number of assets out there. Like, where do you see the opportunity, or where do you at least initially plan on launching?
Right. So we're starting with a relatively small selection of products initially. So that's futures and options on Bitcoin and Ethereum. So quite aligned with the CME in that sense. We are looking at other underlyings. It would be very easy for us to start adding new underlyings. So on Deribit, for example, you have Solana futures and options now. So it would be a good candidate for us as well. What we look at is really the liquidity of the underlying. We expect large sizes to be traded by institutions on D2X. So we basically need to ensure that when we list a product, there will be sufficient liquidity for it. The Luna crisis was an interesting case study for us as well. It shows that even the relatively large market caps are actually not always safe in terms of product listing. And then we have lots of very good ideas of different types of products that we want to list, different types of derivatives, but we'll keep those as a surprise.
And so you mentioned, ensuring that spot markets are liquid enough. How do you go about reference pricing? Are you building your own reference price in house? Because like one of the things that happened back in the day, and I don't know if you remember this, but BitMEX, their reference pricing used to be basically an equally weighted price among 4 or 5 exchanges, of which either ItBit or Bitstamp was one of them, and people realized they could fuck with the underlying price on one of the illiquid exchanges to basically cause cascading liquidations and crash the entire market on BitMEX. And BitMEX is, by the way, a long time ago they fixed that problem. This was fixed 2 or 3 years ago, but curious how you think about reference pricing in this space.
Yeah, so in our case, there are 2 important considerations. One is regulation, again. In order for us to...
Your favorite word.
Yes, I dream of regulation these days. So in Europe, there's a piece of regulation called BMR that basically regulates benchmarks. And because we price our derivatives, because we settle our derivatives over an index, right? They're cash settled. We need to comply with this piece of regulation. It also requires a license, so it's not a benchmark that we can structure ourselves. And we partner with a company called Vinter that is on the ESMA register, that is BMR compliant, and they basically designed and structured the Bitcoin Euro D2X reference rate and the ETH Euro reference rate as well.
And
So,
is this pretty similar to any? They're also providing reference rates for ETFs, right? Or
correct.
okay,
So the methodology is pretty similar to the one the CME is using with CF benchmarks. And you were asking about sort of how we go about structuring these, what are the important considerations. And here the goal is really to make price manipulation almost impossible. So Vinter has done a really great job at defining a methodology that is quite robust to manipulation. And they will look at a large number of trading venues that are deemed, first of all, somewhat regulated and liquid enough. And they have this methodology that is very robust by design. For us, it was really important also that the reference rate is fully independent from D2X, so that you actually do not trigger any sort of liquidations based on events that would happen on the exchange itself.
And so we have a lot of, I don't know if drama is the right word in the US, but maybe it's drama around securities laws, right? And Gary Gensler in the US basically alluding to the fact that everything other than Bitcoin is a security. So how does that impact? That doesn't impact you being European regulated, right? But how are European regulators thinking about crypto? Is there that same talk about these assets being securities? And if so, is that kind of something that would preclude you or is currently precluding you from thinking about listing more at the start? Or is it really just about liquidity?
Right. No, so it doesn't really impact us. I think it would have an impact on the industry overall. Of course, liquidity in the US.
And you're
also
cash settled, right? So I guess you're not even listed. I mean, you are trading. You're trading securities, but they're not. I mean, they're not crypto. It's not underlying crypto.
Yeah, it's not securities per se. It's really derivatives, so it's financial products. Right. But yeah, I think in Europe, in any case, we have a more nuanced approach to this. I think regulators and the European Commission has done a really good job so far at going about this asset class, and with pieces of regulation like MiCA, you see an approach that is quite smart and really tailored to this new asset class. In the US, it feels like they try to classify these as securities mainly for oversight. So depending on how it's classified, different regulators will basically have oversight on these, and everyone is trying to sort of make it fit under their category in that sense. And that's also a big difference between the US and Europe. In the US, you have different regulators for financial markets. In Europe, it's much more consolidated in that sense. So we wouldn't have the equivalent of both the SEC and the CFTC.
And so let's kind of get into the meat of what this podcast is all about, which is, crypto fundamentals. So, let's do a speed run here. So let's do kind of quick answers to all these questions. But, what do you think are the key drivers and determinants of price movement in crypto, right? What is driving the price of Bitcoin and ETH today?
Yeah, I think crypto is a pure supply and demand dynamic. Reacts pretty fast to certain news, and it's still quite sensitive to large trades. So I think large desks that are moving size will impact price a lot.
And so, the one question that we've asked in every single episode of the podcast is fundamentals. So, it's the fundamental value podcast after all. So, how do you define fundamentals for digital assets? Or how do you begin to think about them?
Yeah, it's quite an interesting part of an interesting question, really. I think, coming from a TradFi background, I like to have a rational approach with these things. So the fundamentals are really around tokenomics. Again, supply and demand for a lot of these things. The fundamentals are also really impacted by the consensus mechanism. So, for example, if there's staking rewards, that of course has a big implication in terms of value and pricing. So yeah, to me, these are really the main components. And then the demand is actually really coming from the adoption of the underlying technology. So if you look at Ethereum, for example, the demand for ETH is really a function of the adoption of the blockchain. And I think that's a really important point. Some people see crypto as a speculative asset class. In reality, it's more, it almost feels like a commodity or the input and output of a new technology, of a new ecosystem.
And so fast forward 24 months from now, obviously you're mostly focused on the top two tokens. Let's actually, I've been asking clients or I've been asking guests about, top 100 tokens by market cap, how many will be left 24 months from now? But I think you're focused more on the top at this point. So let's start with the top 10. Out of the top 10 assets by market cap, let's take stable coins out of that equation. How many of the top 10 assets will be left 2 years from now? Not left, but still in the top 10, right? And how many are going to be replaced?
Yeah, I think probably 4 or 5, I would say. I think Bitcoin, definitely. I think Ether, definitely.
And I can give you the list, actually. It's super easy. So Bitcoin, Ethereum, Binance Coin, XRP, Cardano, Solana, Dogecoin, Polkadot, Shiba Inu, oh God, and Polygon is the top 10 right now.
Yeah, so I think the top 5 are quite likely to still be in there. I wouldn't be surprised to see FTT going in there as well. I think these, Dogecoins, Shiba coins, I don't expect them to last very long. Maybe they'll still be there, but I don't expect them to be there on the long run. I think exchange tokens will definitely have a place there. So yeah, Binance Coin I think is a good candidate.
And so does crypto have any real world use case, right? I mean, we talked, you mentioned, where do you think crypto is driven by? It's driven by supply and demand, right? But is there any reason for anyone to want to use these assets, right? Obviously, you're building a cash settled exchange. So, people are not settling in underlying assets, but are there real world use cases for crypto?
Sure, absolutely. And I mean, we're doing cash settle because we just want to build a regulated market infrastructure that works well for institutional players. So that's our angle. But fundamentally, the asset class represents much more than just a speculative asset class. So I was talking briefly about the adoption of the underlying technology, and I think that is really the key here. If you look at Ethereum, I take that example again. When you basically have this whole new economy, this ecosystem of applications that are developed using that blockchain, and this is really sort of a technological revolution. As we move towards adoption of blockchain and it becomes more sort of widely used, that's really where the use case for crypto comes, right? It's really the input and the output of all these technologies. So to me, that's really where the value lies.
And so, where in crypto, are you most excited? What in crypto has you most excited right now?
I would argue large institutions coming in. I think this will really change the way the asset class currently behaves. I think it's still a very young asset class, and you see that by the cyclicality of price action. The magnitude of these market events is typically huge, but it is dampening over time. I think when large institutions come in, we'll get an asset class that is more robust to events, and basically that will really have its place next to the traditional asset classes.
And so my final question for you, what is your hottest or most controversial take right now in crypto? I want controversy, Theo. I don't want a half-baked answer here.
Yeah, that's a good one. I think Yeah, of course, I'm a bit biased because I'm in the space. I think a lot of exchanges are playing a very dangerous game. I think there will be a big backlash around exchanges that have been playing this regulatory arbitrage game. Some of them have done a great job at delivering an amazing product. I've gotten a lot of traction, but at some point, I think you have to play by the rules. So I would expect some heavy litigation in the coming months and years for some of the players. I'm not going to name anyone, but yeah, that's sort of my take.
And so, finally, where can people find out more about you? Where can they follow you? Where can they follow D2X? And if somebody wants to be a counterparty on day one, when you reach out, how can they get to you?
Yeah, so you can reach me on LinkedIn or by email, theodore@d2x.com. Our website, d2x.com, also has some information, and we're also attending a few events, a few conferences. We'll be at DAS in New York, Token 2049 in Singapore, and DAS London as well. So anyone who would like to know more about D2X can also meet us in person there.
Awesome. It was great having you on, Theo, and I hope to do this again when you guys launch.
Great. Thanks a lot.